one of the biggest challenges right now, I think, is reviving growth. Growth has really corrected quite sharply from about 7% plus to 5%, and I think the next few GDP prints are going to be sub 5%. So I think tackling this growth slowdown in a timely fashion would be the biggest priority for the government as well as the central bank. Encouragingly, there's been a lot of action that has already taken place. You've already seen the central bank being the most aggressive in terms of their rate cuts compared to the Asian peers. And apart from that, they've also given a lot of liquidity support. At the same time, the government has also come out with a lot of measures, which have been, some of them have been sector specific, and some of them have been wide ranging for the entire investment community, like the corporate tax cut. So tackling growth slowdown, I would think, is the biggest challenge as well as a priority for the Indian authorities. I think it's a lot of the action that has been taken right now is more to do with the supply side, to mean that, say we were to talk about real estate, for example, because the sector is stuck with a lot of unsold inventory, and there is also a gap for last mile funding for the developers. And they've come out with announced the Corpus Fund, where the government, along with a few other government agencies, is going to pool funding together and provide a hand. So at this point, I think it's more supply support, it's more sector specific, and we expect that to continue to happen over the next 3 to 6 months. I think the next leg of support, I would think, would be from the demand side. From that perspective, I think you could see another support scheme, either extending the support measures that have already been given to the rural community, or introduce new ones, coupled with the personal income tax relaxation. So I think that will provide a short-term impetus to growth, and that we think will be the next leg of support. So this will help with the part of the cyclical issue, the demand support. But apart from that, from the monetary authorities side, I think the central bank will also be looking at providing some relief on 3 fronts. Rates have been cut, liquidity is flush. I think there is still premiums built in the liquidity. So that would be the credit premium, the liquidity, as well as the term premiums. I think that is where the attention will be. And because once these concerns are addressed, you would see the transmission happen at a much faster pace. For instance, the banks have been already asked to peg their repo rate, their lending, part of the lending book, to the repo rate. I think that will facilitate transmission. And as growth comes back, the credit premium depression will also bring down borrowing costs. Apart from that, there are obviously bigger structural issues that remains front and center for the authorities. And on that respect, I think we're still seeing the banking sector deleveraging taking place, which in part also helps the corporate sector get out of the investment malaise that has been for about 5-6 years now. So I think that there is a bigger structural story which is still playing out. But on the cyclical front, we do expect some relief on the demand side as well as from the monetary policy. So we are of the view that I think this year particularly you've got revenues that have undershot budgeted targets, and you've also got an announcement of the corporate tax cuts, which essentially will add some downside pressure to the direct tax collections as well. So which this put together with a couple of more factors. I think the second leg is that the divestment and the strategic sale process has been expedited. I think the list that came out very recently seems to suggest that if all of the plans really play out, that not only meeting but beating the FY20 divestment budgeted target could happen. So that will provide crucial revenue support as well. And in addition to that, we do expect some extent of fiscal slippage. So in the July budget, the target was set at about 3.3%. We think that if you were to take out the revenue undershoot, then you ought to look at the expenditure obligations, and we also look at some fresh revenues coming in from the privatization, from the privatization end. When we put these 3 things together, we do expect a slight slippage in the deficit target. So I think for the FY20, we could see the target being set at about 3.6%, and a slight increase in the FY21 fiscal deficit target as well. So I think this is how any of the additional expenditure will be taken in, because growth at this point requires the government spending to be picked up, which we think will then help the private sector to come back to health as well. So we don't expect any huge cutback in the expenditure outlays, and hence which will mean that there'll be some extent of slippage, which we think will be in the range of about 20 to 30 basis points for fiscal 20. I think it's a good vision to move the country towards the 5 trillion mark, and right now there are only about 2-3 countries in that scale of growth or size. I don't think it is really as important whether it's a 3-year plan, 5-year plan, or a 10-year plan. I think insofar as the enablers are being put into place for the economy to grow gradually towards the 5 trillion mark, I think that would be very important. At this point, I think if you were to look at the growth pace, it's certainly on the softer side. So if you were to put growth and inflation together, which is important for the nominal GDP, we are running at about 8-9%. So given this nominal GDP pace, it's going to be a challenge to reach 5 trillion in about 4-5 years. But again, like I mentioned, I think the direction is as important, not only the magnitude. And hence, working towards that target, I think many of the affirmative action that has been taken by the government as well as the central bank, of course, because of the slowdown that has happened, that multiplier effect has not really shown up very fast. Either in terms of reforms or in terms of monetary policy, the benefit is taking longer than usual to show up, and I think that's part of the structural pain points in the economy. But we do think that we are near the trough of the growth downtrend, and over the next 6 to 9 months, we would see a return back in growth to about 5.5%, and heading into 6%. And I don't think we should be really looking at a V-shaped recovery either, because at this point, addressing the structural blocks, expediting the deleveraging process would be a priority rather than to pump prime very aggressively and result in major imbalances.